Friends, thank you for being here today. We stand at a precipice in our financial history, a moment that feels eerily silent to the general public but is deafeningly loud to those who know where to listen. What if I told you that while the stock market dominates the headlines with record highs and tales of resilience, the very foundation of our global financial system, the plumbing that keeps the money flowing, has just suffered a catastrophic fracture? And furthermore, what if the safety of the banking system you rely on for your retirement is currently being threatened not by a foreign adversary, but by a cockroach infestation of fraud and bad debt hidden within the opaque world of private credit? These are not questions I ask lightly, nor do I ask them to induce panic. I ask them because we have entered a phase of the economic cycle that demands not just our attention, but our utmost scrutiny. We are seeing signals flashing red that we have not seen since the dark days of 2022, and in some cases, since the liquidation panic of March 2020. Something big is broken in the repo markets. And unlike the comforting narratives you might hear from the mainstream financial press, this has nothing to do with the Federal Reserve shrinking its balance sheet and everything to do with a sudden, violent evaporation of trust. Today, we are going to peel back the layers of this complex onion. We are going to walk through the mechanics of a $573 billion warning sign, the unraveling of a massive fraud in the auto loan sector, the potential entanglement of the world's largest bank, and the undeniable macroeconomic currents that are dragging us toward a difficult reality. For those of us who have weathered decades of market cycles, who remember 2008 and 2000, the pattern emerging is unmistakable. It is the pattern of the tide going out, revealing exactly who has been swimming naked. To understand the gravity of our current situation, we must first look at the flashing warning light on the dashboard, the explosion in Repo Fails. For many, the term repo market is esoteric, a piece of Wall Street jargon that seems removed from daily life. But make no mistake, the repurchase agreement, repo market, is the beating heart of the global financial system. It is where banks, hedge funds, and insurers go to pawn their assets, usually U.S. Treasuries, in exchange for short-term cash to operate. It is a market built entirely on collateral and trust. When that market seizes up, the global economy does not just slow down, it risks a cardiac arrest. In mid-December, specifically the week ending December 17th, that heart skipped a beat. A massive, terrifying beat. The Federal Reserve Bank of New York released data showing that repo fails, transactions where one party failed to deliver the promised Treasury security to another, absolutely exploded. The total combined fails for that single week hit 573 billion. Let us pause and contextualize that number because, in the abstract, billions and trillions can lose their meaning. This figure is nearly double the amount of fails recorded just the week prior. It is the highest weekly total recorded since the collateral crisis of September and October 2022, a time of immense global instability. Perhaps, even more shockingly, this 573 billion figure exceeds the worst week of repo fails during the COVID-19 panic of March 2020. During that terrifying week in March 2020, when the world was locking down and liquidity vanished, fails hit roughly 566 billion. We have now surpassed that level in what is supposedly a strong and resilient economy. Why does this matter? A fail in the repo market is effectively a breach of contract. It means that somewhere in the chain of global finance, a bank or a dealer promised to hand over a U.S. Treasury bond to settle a trade and simply didn't. When this happens on a small scale, it is a clerical error. When it happens to the tune of $500 billion in a single week, it is a systemic scream. It tells us that the collateral, the pristine U.S. Treasuries needed to backstop loans, is vanishing from circulation. The mainstream financial media, particularly outlets like Bloomberg, have attempted to explain this away with a convenient narrative. They claim this is the fault of the Federal Reserve. This narrative is dangerously misleading. It is a comforting lie designed to obscure a harsher truth. The reality is that bank reserves actually increased in November. The Federal Reserve isn't sucking liquidity out of the system at a rate that would cause this disruption. The problem isn't that the bonds don't exist. The problem is that the people who own them, the primary dealers and the big banks, are refusing to let go of them. They are hoarding them. When trust evaporates, banks hold onto their pristine collateral like a life raft. They stop lending it out. They stop engaging in the repo churn that keeps the market lubricated. This $573 billion spike isn't a technical glitch caused by the Fed. It is a barometer of fear. It is the banking system signaling that they believe a storm is coming, and they want to be holding the safest assets possible when it makes landfall. If we look deeper into the behavior of the primary dealers, we see clear evidence of why cash is suddenly becoming so tight. These massive institutions act as the market makers. They are supposed to facilitate the flow of cash and securities. Instead, they're acting like doomsday preppers. Data shows that dealer inventories of Treasury coupons, notes and bonds, and Treasury bills have been climbing steadily. As of the latest figures, dealer holdings of Treasury bills have jumped back up to $83 billion. Why would a profit-seeking bank hold onto so much low-yielding safety? Because they are anticipating a credit event. When dealers hoard collateral, the velocity of money slows down. It creates a traffic jam in the financial plumbing. This hoarding behavior explains why the SOFR rate, the secured overnight financing rate, has been spiking above the Federal Reserve's own target range. The SOFR rate is essentially the cost to borrow cash overnight using treasuries as collateral. When that rate spikes, it means cash is scarce. But cash isn't scarce because it doesn't exist. It is scarce because the holders of cash don't trust the borrowers. The rise in Repo Fails and the spike in borrowing costs are two sides of the same coin. They tell us that the smart money is preparing for a liquidity crunch. They are looking at the borrowers, the hedge funds, the shadow banks, the private credit funds, and they are deciding that the risk of lending to them is no longer worth the reward. They are pulling back. And when the big banks pull back, the entities that rely on cheap, easy funding are left gasping for air. This brings us to the root cause of this fear, a phenomenon best explained by the cockroach theory and the rot currently spreading through private credit. There is an old saying in finance: if you see one cockroach in your kitchen, you can be certain there are hundreds, perhaps thousands more hiding behind the walls. You never have just one. For the past few years, we have lived through a boom in what is called private credit, or shadow banking. As traditional banks faced stricter regulations after 2008, a massive industry of non-bank lenders emerged. These firms took money from insurance companies, pension funds, and wealthy investors, and they lent it to companies that couldn't get loans elsewhere. They promised high returns and safety based on proprietary algorithms and private data. This sector has been the darling of Wall Street. It fueled the private equity boom. It kept zombie companies alive. And it was all predicated on one central assumption: that the economy was strong, the consumer was resilient, and interest rates would stay manageable. But as the economic tide has begun to turn, a phenomenon we will discuss later regarding the flat beverage or labor market cooling, the truth about these loans is surfacing. The strong economy narrative allowed for what Jeffrey Gundlach famously called garbage lending. Deals were done without due diligence. Billions were lent based on loose terms. Volume, volume, volume was the mantra. And now the cockroaches are scuttling out into the light. We are seeing a sudden, violent repricing of risk because the banks have realized that the collateral backing billions of dollars in loans is, in some cases, completely fictitious. The repo market is breaking because banks are asking themselves, if I lend money to this firm, is the collateral they are giving me real? Or is it just another spreadsheet error? This is not theoretical. We have a concrete, terrifying example that has shaken the confidence of the entire street. If you want to understand why a $573 billion freeze happened, you have to look at a specific case study in systemic fraud, the Tricolor scandal. The story reads like a crime novel, but it is a reality that has cost investors hundreds of millions, perhaps billions of dollars. Tricolor was a company that made loans to people with poor credit, so they could buy used cars. They then bundled these loans and used them as collateral to borrow money from major banks. It is a standard business model, assuming everyone is honest. Tricolor was not honest. Federal prosecutors have now charged Tricolor executives with systemic fraud. The details of the indictment are breathtaking in their audacity and in their stupidity. The fraud centered on a double pledging scheme. In the world of secured lending, you are only supposed to use an asset, like a car loan, as collateral for one loan. Tricolor, however, was allegedly pledging the same car loans to multiple different banks at the same time. They were effectively selling the same house to 3 different people. How did they get away with this? How did sophisticated Wall Street risk management departments not catch this? The answer is both shocking and mundane. Excel spreadsheets. According to the charges, a Tricolor employee was tasked with doctoring the spreadsheets that were sent to financiers. They would list delinquent loans, loans where the borrower had stopped paying, as current and healthy. In other columns, they failed to reduce the outstanding balances. They were keeping 2 sets of books. One set showed the reality of a collapsing portfolio. The other set, the one sent to the banks, showed a profitable, healthy company. This went on for years. The fraud was only discovered when a junior analyst at an asset management firm noticed a discrepancy that was described by the firm's founder as the stupidest effing thing he had ever heard. A simple math error in a spreadsheet unraveled a billion-dollar scheme. But the horror here isn't just the crime, it's the negligence of the lenders. Major global banks were lending hundreds of millions of dollars to a subprime lender based on unverified spreadsheets. They did not check the underlying titles of the cars. They did not verify the cash flows. They simply took the Excel file, said looks good, and wired the money. Why? Because of the bubble psychology. When the Federal Reserve and the media tell you the economy is strong, You stop checking the details. You assume the borrower is good for it. You assume the collateral is real. The Tricolor collapse shattered that illusion. It forced every risk manager on Wall Street to look at their own portfolios of private credit and ask, do we have any Tricolors on our books? And when they started looking, they found that Tricolor wasn't the only cockroach. We are seeing similar distress signals from giants like KKR, Kohlberg Kravis Roberts. KKR is one of the most prestigious names in finance. Yet their business development company, BDC, a vehicle for private credit, has seen its stock price plummet nearly 33%. Reports indicate that their non-performing loan rate has jumped to 5%. But if you include strategic defaults, the real bad loan rate is closer to 14%. We are seeing the rise of payment in kind, PIK, loans. This is a mechanism where a borrower who cannot afford to pay the interest on their debt is allowed to pay with more debt. It is the corporate equivalent of using a new credit card to pay off the minimum balance on your old credit card. It doesn't solve the problem, it compounds it. It is the hallmark of a zombie company. The Tricolor fraud and the distress in KKR's portfolio are not isolated incidents. They are symptoms of a systemic disease. The realization that billions of dollars in assets held by banks and insurers are essentially garbage. The story gets darker when we realize that this contagion has potentially reached the very top of the financial food chain, entangling the whale in the net, JP Morgan Chase. We're not just talking about obscure shadow banks anymore. In the fallout of the Tricolor bankruptcy, a group of creditors filed a Rule 2004 motion in a Texas bankruptcy court. This is a powerful legal tool that allows creditors to investigate the financial affairs of a debtor, and crucially, third parties involved with the debtor. The creditors are demanding to see communications and financial records between Tricolor and JP Morgan. Why? The allegations are explosive. The motion suggests that JP Morgan, which acted as both a warehouse lender, lending money to Tricolor to make loans, and an underwriter, helping Tricolor sell bonds to investors, may have known about the fraud before anyone else. The timeline is suspicious. JP Morgan terminated its service agreement with Tricolor on September 5th, 2025. This was 4 days before other trustees sent similar notices. The creditors are asking, did JP Morgan use its informational advantage to get its own money out first, leaving other investors holding the empty bag? Furthermore, there are reports that JP Morgan was advising Tricolor on a potential initial public offering, IPO, back in 2024. During the due diligence for that IPO, it is alleged they discovered financial irregularities and past misconduct. The IPO was scrapped. But, and this is the critical question, did JP Morgan continue to underwrite securitizations after discovering these irregularities? Did they help Tricolor sell bad bonds to the public to pay off the loans Tricolor owed to JP Morgan? If these allegations are proven true, it would mean that the largest bank in the United States was unknowingly, or perhaps knowingly, entangled in a massive Ponzi-like scheme. This possibility is a nuclear bomb for trust in the repo market. If JP Morgan, with all its resources and sophistication, cannot verify the collateral it holds, then who can? If JP Morgan is suspected of offloading bad collateral onto the market to save itself, then every other bank becomes paranoid. If JPM is dumping this paper, a dealer might think, I'm not touching it. This is why the repo market broke in December. It wasn't a computer glitch. It wasn't the Fed. It was the realization that the pristine collateral circulating in the system might be infected with fraud, and that the biggest players might be trying to quietly exit the building before it collapses. I have to pause here and ask you directly, does hearing about this level of negligence and potential corruption in the banking system change how you view the safety of your own assets? I would love to hear your thoughts in the comments below. Let's start a conversation about trust, because right now it seems the banks have lost theirs. You might be asking, why now? The answer lies in the macroeconomic trigger we call the flat beverage economy. Frauds like Tricolor can exist for years as long as money is cheap and the economy is growing. They unravel when the economy slows down. As Warren Buffett famously said, only when the tide goes out do you discover who's been swimming naked. The tide is going out. The flat beverage economy refers to the beverage curve, an economic indicator that tracks the relationship between unemployment and job vacancies. A flat or shifting beverage curve indicates a broken labor market, one where efficiency is lost and jobs are disappearing. For much of the year, the Federal Reserve and the White House have touted a strong labor market. But the data underneath has been rotting. We have seen massive downward revisions to payroll numbers. The solid job gains reported in early 2025 turned out to be statistical mirages. When you strip away the government hiring and the part-time jobs, the private sector labor market has stalled. This is the flat beverage reality. Real people are losing real income. And when people lose income, what is the first thing they stop paying? Their subprime auto loans. The spike in delinquencies among subprime borrowers was the spark that lit the fuse. When borrowers stopped paying Tricolor couldn't doctor the spreadsheets fast enough to hide the holes. The cash flow dried up. The fraud was exposed. This domestic weakness is being mirrored internationally, creating a feedback loop that puts even more pressure on the repo market. We must look at the behavior of foreign central banks and reserve managers. These entities hold massive amounts of U.S. debt, treasuries, as a savings account. When they run into trouble, when their own economies slow down or their currencies crash, they sell those treasuries to raise cash. Data from the Federal Reserve Bank of New York shows a massive exodus of foreign capital. Between late July and December, $168 billion in foreign official assets vanished from custody accounts. This is a staggering sum. It tells us that foreign governments are desperate for dollars. They are selling their U.S. bonds into a market that is already nervous. This selling pressure adds to the indigestion in the bond market. Dealers are already flooded with treasuries they don't want to buy, and now foreign governments are dumping billions more. This drives down the price of bonds and drives up yields, tightening financial conditions even further. So we have a perfect storm. A slowing economy causes borrowers to default. Defaults expose the cockroaches in private credit. Fraud like Tricolor destroys trust between banks. Loss of trust causes dealers to hoard collateral and refuse to lend in the repo market. And as a result, Repo Fails explode to $573 billion, signaling a systemic freeze. As we look toward the future, we must pay attention to the signals of deflation and depression that have correctly predicted this mess. The most ominous of these is the copper to gold ratio. Copper is known as Dr. Copper because it has a PhD in economics. It is an industrial metal. Its price rises when the global economy is building, manufacturing, and growing. Gold, on the other hand, is a fear asset. It rises when investors are scared of currency devaluation or systemic collapse. When you divide the price of copper by the price of gold, you get a ratio that tells you the market's verdict on the future. A rising ratio means growth and inflation. A falling ratio means deflation and contraction. Today, the copper to gold ratio is sitting at record lows. It is lower than it was during the 2008 financial crisis. It is lower than it was during the 2020 pandemic lockdowns. This ratio is screaming that there is no upside. It is forecasting a deflationary depression. It is telling us that despite the inflation we have felt at the grocery store, the next phase of this cycle is a collapse in demand, a collapse in credit, and a collapse in asset prices. This aligns perfectly with the bull steepening of the yield curve we have witnessed. After months of an inverted yield curve where short-term rates were higher than long-term rates, the curve is steepening. Historically, this uninversion is the final signal before a recession officially begins. It means the market is pricing in aggressive rate cuts because it sees the economic damage hitting the wall. Before we conclude, we must address the invisible war brewing between the banks and the shadow lenders, a conflict that directly threatens your financial security. This is not just a story of silent exits and hidden balance sheets. It is becoming a public brawl between the titans of finance, and the stakes are your pension funds and insurance policies. Recently, Colm Kelleher, the chairman of UBS, one of the world's most conservative and significant banks, issued a blistering public warning. He didn't just hint at trouble, he pointed a direct finger at the private credit industry and, crucially, the insurance regulators who are supposed to be watching them. He warned that credit ratings arbitrage and poor insurance regulation were creating massive systemic risks, particularly in the United States. This sparked an immediate and heated war of words with Mark Rowan, the CEO of Apollo Global Management, one of the kings of private credit. Rowan shot back, claiming Kelleher was just wrong. But why would the chairman of a Swiss bank pick a public fight with a Wall Street giant? The answer lies in who is buying all this debt. It is the insurance companies. In a desperate reach for yield to pay out annuities and policies in a low-interest world, insurance companies have been loading their portfolios with private credit assets. They are buying the debt of companies like Tricolor. But here's the trap. To buy these risky assets, they need them to be rated investment grade so they don't have to hold too much capital in reserve. This has birthed the phenomenon of ratings arbitrage. Private credit firms are accused of shopping around for ratings, going to smaller compliant agencies, sometimes called private letter ratings, that will stamp a AAA or AA rating on a pile of debt that, in reality, might be junk. Why does this matter to you? Because if you hold an annuity, a life insurance policy, or a pension, that money is likely invested in these optimized assets. The insurance companies are betting that the ratings are real. The big banks, like UBS and JP Morgan, are looking at the same assets and saying, this is garbage. The banks are terrified that when the flat beverage economy causes more defaults, the insurance sector will face a solvency crisis. If the insurance companies have to sell these assets to raise cash, who will buy them? The banks certainly won't. The liquidity will disappear instantly. This war of words is the final piece of the puzzle explaining the repo freeze. The banks aren't just hoarding collateral because of one fraud. They are hoarding it because they see an entire industry, insurance and private credit, built on a foundation of arbitraged ratings and misunderstood risk. They are locking the doors because they know that when the house of cards falls, they don't want to be the ones holding the bag. Friends, if you are finding this analysis helpful and want to stay ahead of these economic shifts, please take a moment to like this video and subscribe to the channel. It helps us get this crucial information out to more people who need to protect their wealth. The explosion in Repo Fails to $573 billion is not a random statistic. It is the sound of the fortress closing its gates. The banks and primary dealers, the institutions that see the flow of money before anyone else, are barricading themselves inside the fortress. They are hoarding cash. They are hoarding high-quality collateral. They are cutting off lines of credit to the risky shadow banks and the subprime lenders. They know what is coming. They see the fraud unraveling in the private credit markets. They see the cockroaches scurrying out from the cracks of the strong economy narrative. They see the labor market stalling and the foreign bid for treasuries drying up. The something big that broke in the repo markets is trust. The assumption that everything is fine has been replaced by the realization that nothing is verified. For those of us over 60, this is a time for extreme caution. The financial media will continue to tell you to buy the dip and that the Fed has your back. But the data from the plumbing of the financial system tells a different story. It tells a story of a system that is rapidly deleveraging, forcing liquidations and exposing fraud. We are watching a slow-motion train wreck in the credit cycle. The Tricolor fraud was likely just the first car to derail. As the flat beverage economy continues to expose the weakness in the American consumer, more dominoes will fall. Do not be distracted by the stock market's daily gyrations. Watch the plumbing. Watch the repo fails. Watch the credit spreads. These are the indicators that tell the truth. And right now, the truth is that the system is broken and the smart money is moving to safety. Thank you for listening. Stay vigilant, stay skeptical, and protect what you have built.